Yes, people, let's continue our revision discussion. Now we are discussing accounting standard 15 that talks about employee benefits. So the scope of this standard is very straightforward. If at all you are paying some benefits to employees, how they should be accounted, measured, recognized, disclosed, blah, 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 all that guidance in AS 15. Okay. One good thing is significant portion of AS 15 and CA final ka India is 19 same. So whatever you're going to learn will be carried forward. So all the more reasons to pay, learn it more diligently. Okay, first one. Sir, as far as AS 15 is concerned, employee benefits are of 4 types. For accounting per se, standard puts benefits under 4 categories. First one, short-term employee benefits, post-employment benefits or retirement benefits, termination benefits, other long-term employee benefits. For accounting purpose, benefits are either categorized into one of the 4. For each of them, slightly different accounting is suggested that we will learn. This is the first thing. Okay. Whenever you see an employee benefits, put them under one of these 4 categories. That's the first step. Alright. Now some basic things. Sir, employee benefits does not mean you have to pay the benefits to employee. You can pay the benefits directly to employee or to their dependents. Now employee is saying, I am just coming and working, but the real strength for me is my wife. Please transfer salary to my wife's bank account. Employee is telling the company. Okay. And the company transferred salary to whose account? Wife's bank account. That is also considered as employee benefit only because wife becomes their dependent. Or if husband says, if it's ulta case, that is also what? Basically, if money comes into any of your relative side, any of your dependents, husband or wife or children or your father or matashri, pitashri, siblings, so all will be coming under what aspect? Dependent. If the salary or employee benefits, if it is paid to the dependent, still it will come under the scope of AS 15. Or to beneficiaries. Beneficiary means employee told, I will work, but my salary you put it into TTD. Tirupati Tirumalam Devasthanam. Goinda. Literally salary Goinda. Employee is telling, I will come and work, but my salary you transfer it to trust. Still it is an employee benefits. Okay. So benefits need not be paid to their employees. It could be paid to the dependents as well as beneficiary. Anyone and everyone is considered as for this purpose. That is one. Next, sir, who is considered as an employee for this purpose? For AS 15 application purpose, employee means full-time, part-time, casual, articleship students. Next, you will go for articleship or interns. You are also employees for AS 15. Even directors are also considered as employees for this purpose. Whether it is full-time, part-time, whole-time, whatever time, everybody will be considered as employee for this purpose. This is a basic thing. Now we'll dive into the categories. What did I say? Whenever there is an employee benefits, you should put it under one of the 4 category. What is the first category? Short-term employee benefits. For class purpose, we'll call it as STEB. Short-term employee benefits. Now, if it is STEB, what we have to do? First of all, STEB means what? Full form is short-term employee benefits. Sir, short-term employee benefits means they are those benefits which are payable within 12 months from the end of current financial year in which the service is rendered. Short-term employee benefits means basically short-term, long-term category is 12 months. This we are aware of, no? Yes. What the standard is trying to say is, let's look at this example to understand better. Sir, suppose an employee gave service on 1st January 2024 and the balance sheet date or the year ending date is 31st March 2024. Sir, you already know short-term means less than 12 months. Long-term means more than 12 months. You have to count, no. What standard says is for that counting of 12 months, don't take service date. For that counting of 12 months, don't take a service date. This service is falling in current year. When is current year ending? 31st March 2024. Count 12 months not from 1st January but from what? 31st March 2024. So count 12 months from here. What day it will be? 31st March 2025. If this service ka benefit, if the service ka payment, if it is paid within 31st March 2025, if it is paid within 31st March 2025, then it gets called as what? Step. It is 12 months only, 12 months not from the service date, 12 months from the current year ending date. That's all it is. That's what they're trying to express. Not that you need to know the exact words, but meaning did you get? Count 12 months from what date? From the current year ending date, you have to count 12 months. And if that payment is getting settled within this window, then it is a short-term employee benefits. If it goes beyond the 31st March, if the payment is made beyond 31st March, then boss, it is not step. It is something else, which we will see what is. Okay, now that is the meaning. Sir, examples of short-term employee benefits are your salary, perquisites, and all you have learnt in your income tax. No, all that will come under the ambit of step. Because if you work January month, if you work means when will you collect the salary as employees? 1 year later, 1 day later only you will do labo. Correct? No, right? 1 year and all you will wait. No chance. So salary, perquisites, all these are examples of what? Step. Now you tell me here, time value of money is material. April ka salary usually will be settled in May. Maximum 1 month. Yes or no? So that means, should we have to find present value, future value? All that drama is required for step or not required? Not required. Because settlement you are doing within what? 12 months. Sir, if the settlement is going beyond 12 months, we say time value effect is material. You have to do accounting on what terms? Present value, future value. You know how to find present value, no? How do you find present value? Take the future value and multiply by the discount factor. That is required or not required? Not required. That's what I've written here. For step, discounting is not required. Why? Because the time value effect is not material. Done, Ji. And we do some accounting called expense liability accounting. What accounting? Oh, expense liability accounting. You know this. You know this. Just fancy name. Sir, salary not paid. What is a journal entry? Salary accrued but not paid. Salary accrued or not paid. Salary account debit to outstanding salary. Correct? Salary is an expense. Where it will go? P&L. Outstanding salary. Where it will come? Balance sheet. Where? It's a liability. What is the word saying? Recognized as expense and liability. Right? This is the accounting. That's all. Fine now, people. If you have not paid salary, you will show it as what? Outstanding salary. Outstanding salary obviously is what? A liability. That's the accounting. We simply say expense and liability accounting. If you have already paid expense, if you already paid this expense account debit to bank. But usually what happens is March month ka salary company don't pay in March. They pay it next month in 4 days, 5 days time. April ka salary they'll pay it in May first week. Hence we always book outstanding first and then the settlement entry. That's the reason we say we follow what accounting? Expense liability accounting. And where will this expense go to? Where will this expense go to? P&L. Sir, suppose this expense is a DAC. Suppose if this expense is a DAC, it may get added to the cost of PP or intangible asset also. Possible, no? Suppose an employee is doing installation of plant and machinery. Installation charges goes to P&L or capitalized. But who is doing installation? Employee. That means that employee ka salary will not go to P&L, rather it will be added to the cost of PP. Usually that expense goes to P&L, but it can also get added to the cost of asset, provided it is a DAC. Next one. Sir, short-term employee benefits, usually normal short-term employee benefits like salary and all, they won't ask in exam. One of the short-term employee benefits can be targeted in exam. That is called paid leaves. Called paid leaves. This is an important concept. It can come. It comes in final also. It comes here also. There is a good scope. You can build a lot of questions around this. So let's learn what is this concept of paid leaves. I've written the next chart for this. Let's look at this. This is about the leave wala concept. Sir, every employee who works in the organization, they'll get certain amounts of leave. Right? No, casual leave, annual leave, sick leave, like this, various leaves will be given to them. Right? Okay. 1 minute. So, for that leave, should we do any accounting is what we are trying to learn here. So, whenever there is a leave, first you need to check whether it is a non-accumulating leave or an accumulating leave. Non-accumulating leave means very simple. Sir, suppose one employee has been awarded 20 leaves in 1 year. In 1 year, how many leaves can he take? 20. If that employee takes 20 leaves, salary will be cut or full salary? He will get full salary, right? So what the company is saying is, if you take the leaves, good for you. If you even don't take the leave, good for you only. I will not give you any extra money. What is the company telling? Take the leaves, right? Even if you don't take, will you get extra money? No extra money. No extra money, and you can't carry this leave forward. This year leave, you can't utilize it in the next year. If you take the leave, good for you. If you don't take, simply the leave will get what? Lapsed. Such a leave we call it as what, sir? Non-accumulating leave. For non-accumulating leave, you don't have to do anything. There's no extra accounting required for this. But an accounting is required for a leave called accumulating leave. Okay, this is what usually they will ask in exam, if at all it comes. Accumulating leaves are further subcategorized into vesting leave, non-vesting leave. Vesting leave ka another name is encashable leave. Non-vesting leave ka another name is non-encashable leave. What is this? First, I'll tell you in provision, then we look at one small example if you want. So, name itself is saying vesting leave, or another name is what? Encashable. Okay, or maybe let's learn it with the help of example. Okay. So, let's say in one of the year, one employee is eligible to take how many leaves? 10 leaves. But he took only how many leaves? 7 leaves. How much balance is there? 3 leaves. This is what has happened in one particular year. He was eligible for 10, or he or she took only 7. How much balance? 3. If it is vesting leave, what will happen is, how much leave employee did not take? 3. That 3 days ka extra salary he will get. That 3 days ka extra salary company will pay to that employee. Such a leave you call it as what? Vesting leave or encashable leave. Goindana got it up. Okay, like let's put up more numbers. Let's say that particular employee ka salary is 30 lakh rupees per annum. The whole year ka salary is how much? 30 lakh. Let's say in a year, number of working days is only 300. There is Saturday, Sunday, Yogadi, politician, Damaro, all this will be there, no? All that if you eliminate, how many is the working days? 300. That means what is salary per day? For working 300 days, employee is getting a salary of 30 lakh. What is salary for 1 day? 30 lakh divided by 300, how much is that? 10,000 per day. That is a salary per day. How much leave employee did not take? 3. Correct? And what is salary per day? Per day the salary is 10,000, and how many leaves not taken? 3 days. So that means how much amount employee will get? 10,000 into 3, which is 30,000. This 30,000, that means this employee will not get 30 lakh salary. In the current year, he will get 30 lakh plus what? 30,000. This 30,000 extra cash the company will pay to that particular employee. If it is what kind of a leave? If it is vesting leave. That's all it is. Correct? Sir, if company is giving extra amount, means they should pass entry or ignore? They should pass entry or ignore? Entry. What is the entry? Instead of salary, give me P&L account ka heading. P&L account ka where it will come? What is that? Employee benefit expense. Tell me the entry in that format. Employee benefit expense account, debit. First, in these cases, you make provision and then you settle provision. So again, tell me the entry keeping that in mind. Employee benefit expense account debit to provision for leave encashment. There's a leave adjustment, no? So employee benefit expense account debit to provision for leave encashment. How much? In this example, 30,000. That's it. Or payment also you have to do. Settlement also you have to do. When it is settled, what entry? Provision for leave and encashment account debit to bank. This is the entry you have to pass for encashable leave or vesting leave. Got the meaning of this now? Okay. There is another kind of leave called what, sir? If it is not vesting leave, if it is not vesting, then another name is called non-vesting leave or non-encashable leave. In this case, what will happen means, instead of leaves, you will get leaves. What did I say? Instead of leaves, you are not getting cash, you are getting leaves. Meaning, how much leaves employee did not take in the current year? 3. This he can utilize in the next year. He can carry this leave forward and utilize in the next year. Only next year, sir? No, how many ever years he want, that is based on company ka policy. Okay. So here, will he get extra salary or he can carry this leave forward? If an employee can carry the leave forward, then such a leave we call it as what? Non-vesting leave or non-encashable leave. Easy, people. That's the meaning. Here also you will pass the same journal entry. Tell me, what is the journal entry? Employee benefit expense account debit to provision for leave encashment. But this provision will get settled. Will the company pay extra salary? No. So here what you have to do is, first I'll tell you the treatment. Here what you have to do for non-vesting leave is, make the provision in the current year, reverse it in the next year. Make the provision in the current year and reverse it in the next year. Sir, why, sir? The concept is this, matching concept. What did I say? Matching concept, or another way. Okay, instead of going into all that, look at this over here. This example you take, another one I built it up. Let's say first year an employee ka salary is 30 lakh. He was eligible for how many leaves, he or she? 30. But leave taken is only 20. Eligibility is how much? 30. Taken is only 20. How much leave not taken? Okay, agreed. That means this particular employee has worked more in the current year. Do you agree with me? He had to ideally work what? I mean, he could have taken how much leave? 30. That employee took only 20. How much leave that employee did not take? 10. If he has not taken leave, means he has worked more. If he has worked more, means company also would have earned more in first year. Correct? No. The more and more time employee spends in the company earnings will be more. What does matching concept say? Income and expenses should be relatively matched. Yes or no? So if in the first year company has earned more, means expense in the first year also should be more. Like here, how much leave not taken? 10. What is the salary per day? 10,000. So how much expense you will book? 30,000 is the extra expense company will book in that year. Agreed? For this, what entry company will pass? For this, what entry company will pass? Oh, too much sound, huh? Ask him to take lunch break, pa. They'll probably tell us only, no? You only take lunch break. Okay. What entry the company will have to pass here? Employee benefit expense account debit to provision for leave encashment. How much? 30,000. You make that provision in the current. Okay, see? You make the provision in the current year and you reverse it in the next year. When you make the provision, in fact, I'll write the entry once again. What is the entry? Employee benefit expense account debit to provision for leave encashment. How much is that? 30,000. Means, can you tell for first year what is the total employee benefit expense? First year, 30 lakh normal salary plus 30,000 booked extra. First year, how much have you booked? 30 lakh 30,000 is an expense company will book in which year? First year. Okay. Look at the drama in the second year. You will get a better idea. Now this leave can be carried forward. Now, how much is the leave eligible in the second year? Every year he gets 30. Yes. Plus he also gets 10 of the last year. If you want, you can make eligibility as 30 plus 10, which is what? 40 also. 30 of the current year plus 10 from the last year. How much eligible? 40. This time employee took full 40 he took off. Full 40 he took off. That means what was the normal leave policy of 1 year? 30. The normal leave policy is how much for 1 year? 30. But did he take 30 in the year 2 or 40? 40. Means in the second year, employee worked more or employee worked less? Employee worked less. So you should book more salary or less salary? Less salary. So second year, what you will do is, this provision will get settled or reversed. What is the reversal entry? Provision for leave encashment debit to employee benefit expense 30,000. Okay. Now that year ka salary is how much? 30 lakh. And you have credited employee benefit expense by how much? 30. That means second year you will book employee benefit expense how much? 30 lakh minus 30,000, which is what? 29 lakh 70,000. This is your matching concept. 1 year you book more, next year you book less. So that both the year ka salary, if you add, you will get 60 only. Because salary is how much? 60. But because first year employee worked more, you have to book more expense. Next year when he works less, you book less expense. That's the reason we say make the provision in that year and reverse it in the next year. That's all you have. Give you a minute. If you have anything, you can ask. Looks like now they're not stopping only, Noda. My throat will be gone only like this. Okay, I think you guys are good. This is about short-term employee benefits. Now the second one, what is the second one? Post-employee benefits or retirement benefits. This is quite important from the examination context, both at inter-level as well as at final level. So post-employment benefits are of two types. DCP, DBP, defined contribution plan, defined benefit plan. This post-employment benefits can either be a defined contribution plan or a defined benefit plan. Defined contribution plan means company has an obligation just to contribute. Company has an obligation just to contribute, like PF. In PF, mein, what is company ka obligation? Can you tell me? In PF, you have studied tax. No? So what is company ka obligation with respect to PF? Company has to contribute their share to the PF authorities. After that, if PF authorities does not settle the money to employee, is it company's headache? What do you think company will say? Company will say, you ask PF authority, I have already paid them. Yes, sir. That means company has an obligation just to what? After that, what happens to that is it is not company ka headache. Such a plan, we call it as what? Defined contribution plan. Like insurance premium. Company will give insurance on employees' behalf. What do you think company will do? They will just pay that health insurance premium to insurance company. If a insurance company rejects the claim, that's a transaction between whom and whom now? Insurance company and employee. Will company come into picture or they will say not my problem? Not my problem. Company ka problem is only what? To pay the premium to insurance company. So that only we call it as what? Those are all examples of what, sir? Defined contribution plan. Do you think April month ka PF company will remit after 15 months? Huh? When will the remittance happen? Immediately. So time value money, material or immaterial? What accounting you will do? Expense liability accounting, like what? Step. Same like step. What entry you will pass, tell me? Employee benefit expense account debit. First you make provision always here. Huh? Employee benefit expense account debit to provision for DCP. When it is paid, provision for DCP to bank. That's all. Done. Simple accounting. No discount factor, no present value, no nothing. So in DCP plan, we say there is no actuarial risk, there is no investment risk. What is that? I'll tell you in a bit. There is no actuarial risk, there is no investment risk. In what sort of a plan? Defined contribution plan, or DCP. Another one is important. This is where a little accounting is required. That is called defined benefit plan, called DBP. Defined benefit plan. For class purpose, we are calling it as DBP. Name itself is saying defined benefit. Defined benefit. Here, company will have an obligation to pay full benefit, not just to contribute, but to pay full benefit. Company cannot just contribute and keep quiet. They have an obligation to pay to the employee full benefit. Hence, the name is a defined benefit plan. Take example. Gratuity. Let's take example. Gratuity ka income tax calculation is what? 15 by 26 into last drawn salary into number of completed years of service. Let's say company is paying gratuity using this formula only. Okay, now again 15 by 26 into last drawn salary. Okay, sir, last drawn salary means today's salary or retirement salary? Retirement salary. Retirement salary retirement salary of the employee company will know now only, or they can only estimate. They can estimate. Initially, company thought the last drawn salary will be 1 lakh. Initially, they thought last drawn salary of this employee will be 1 lakh. And they thought that this employee will serve for 5 years. Will serve for how many years? 5 years. Plug the numbers into formula. 15 by 26 into last drawn salary, company estimated to be 1 lakh. Number of years company is estimating to be 5 years. This is the number you will get. Correct? Yes, sir. Okay, trust the calculation, leave that. It's fine. Now people, that employee was a super duper employee. He got promotion after promotion after promotion. Oh, salary from 1 lakh became 2.5 lakh. Final last drawn salary was how much? 2.5 lakh. Assumption. Because he or she got a lot of promotion. Now calculate the gratuity liability. 15 by 26 into what is the last drawn salary? 2.5 lakh. Let's say that employee retired after 5 years. It will be 721. Correct? Now, can listen to this carefully. Can the company tell that employee? Can the company tell that employee, hey macha, I only thought I'm going to pay you how much? 290. I will not give you 721 da. I will only give you 290 da. Please take and go da. What will he say da? Go da? Yes or no? Correct or no? So company has an obligation here to pay 290 or 720? 720. Yes. So since company has an obligation to settle full liability, we call such a plan as what? Defined benefit plan. Pension, gratuity, all these are examples of what? Defined benefit plan. Because company has to pay the full benefit. They cannot escape from it. Cut. Okay. Here, no. Some accounting, some kidney you will have to use. What is what kidney is? We will see. First of all, settlement will happen today or on the retirement. Retirement company is estimating in this example over how many years? 5 years. So time value of money, immaterial or material? Accounting is happening now. Settlement will happen after 5 years. Time value immaterial or material? So discounting not required or required? In this DBP plan, you have to use the discount. Present value, future value accounting comes into picture. That is one. Okay. So here we do an accounting. There is a method. We use that method called PUCM method. PUCM, projected unit cost method or projected unit credit method, we say. We don't have to know the name. It's okay. If you know how to solve it, that's good enough. So we use this particular thing and we do the accounting. I'll tell you how that accounting works with the help of one question. Not that popular, still we'll quickly run through it. Now people, in this particular DBP plan, there is actuarial risk as well as there is investment risk. Actuarial risk and investment risk is still available. What is that? Sir, what do you mean by actuarial risk, sir? Sir, check this example. Initially, company thought how much is going to be the liability? 290. Finally, how much it turned out to be? 720. So there is a risk that actual liability can be more than expected. There is a risk that what? Actual liability can be more than what company thought. That only we call it as actuarial risk. The actual liability may be more than what company thought. Here that risk is not there or it is there. It is there. In case of DCP plan, company should worry about that. No, company's obligation is just to contribute. After that, we will not worry about it. So here in DCP may there is no actuarial risk, but here may there is actuarial risk. Got the meaning of it? Yes. Okay. Here there is also something called investment risk. There is also something called investment risk. What is that? Sir, this liability is for all the employee or one employee? One employee. Big companies will have thousands of employees. Now imagine 500 people resigning on a single month. Possible, no? You have like 50,000 manpower. Your employee strength is 50,000. 500 people can retire one day, no? Or they can quit, no? So if you do this amount is small or very big. It will come into crores, yes or no? 3.5 crores, something will be the amount, correct? Yes or no, people? I mean, these are all small liability or big liabilities. Big liabilities, and company cannot escape from all this. They have to settle. Sir, will anybody keep hundreds of crores idle money in bank account? Right? When an employee retires, you have to settle the amount. But nobody likes to keep the money idle. Hence, what the companies do is, they invest the money in some safe securities. To safeguard them, to make the money available, what do? They invest the money periodically, every month or every 6 months or every quarter, they'll invest some money in safe securities, government securities, fixed deposit, etc. They will invest. Okay. That means they will make an investment. That investment we call it as plan assets. Just a fancy name. Instead of just calling it as investment, we call it as what? Plan asset. It's an investment purchase. That's what. Sir, when you have purchased an investment, you will expect some return. You expected 8% return. We expected how much return? 8%. But we got only 7. Possible? Because every year interest rate will be same or it is dependent on country ka policy. Based on economic policy, the return also will change. Yes or no? We expected how much? 8%. But finally, overall, if you check, we got only 7. This could happen. That is your investment risk. The risk that the actual return may be lower than expected. We are expecting more, but we got less. Such a risk, we call it as what's a investment risk. If you are making an investment, obviously you will have what risk? Investment risk. So in DBP plan, you will have an actuarial risk as well as you will have a investment risk. Both are available. And we follow an accounting called PUCF. Okay, let's take up one question just to give you a little more context to this. Study mat question. And just keep your calculator with me. No need to just flip over the notes and all. Just calculate some basic things. That's all. An employee, Roshan, has joined company called XYZ in the year 20x1. The annual emoluments of Roshan is decided as 14,90,210. His annual salary is 14,90,210. The company has a policy of giving lump sum. Read this. The company has a policy of giving lump sum payment of what? 25% of the last drawn annual salary. How much ever is the last drawn annual salary? 25% of that company will give as benefit. For what? For each completed years of service. Okay, now same like gratuity calculations. Okay, but here it is calculated at what? 15 by 26 or 25%? 25%. So what's the formula of this benefit? Can you tell me? What is the formula of this benefit? 25% of last drawn annual salary multiplied by number of years of service. Easy. That's how the company is giving benefit. Company is just contributing or company has an obligation to pay full benefit? Company has an obligation to pay full benefit. DCP or DBP? DBP. Okay. All right. If the employee retires after completing how many minimum years of service? To get this benefit, an employee has to serve minimum of 5 years. The salary of Roshan is expected to grow at the rate of 10%. Currently, his salary is 14 lakh something. His salary will be same every year or it will increase. Growing means increasing. By how much? 10%. Okay. They are saying that this employee will get how many increments? 5 yearly increment. That means his last one salary will be this much amount, or you have to add 10%. Add 10%. How many times you will add? 5 times. Because now for in next year his salary will be 14,90,210 plus 10%. Like this, you have to add 10% how many times? 5 times. Or also you can use that present value future value formula. If you want future value, you simply take present value into 1 plus I whole power. Man, mathematics may used to do, no? That way also you can calculate. Or simply add what? Add 10% 5 times in your calculator. 14,90,210 plus 10%. That's what I've written. Okay, first step. We said what method are we following? Projected unit credit method. In this method, the first step is to find out last drawn salary. In majority of the problem, last drawn salary will not be given. First find that. How much are you getting? 24 lakh. Got it? Huh? You calculate like this or simply add 10% 5 times and get it. Okay, Ji. Next, you have to calculate total benefit. You have to calculate what? Total benefit. Here we call it as total projected cost. Instead of total benefit, we call it as total projected cost. How are you calculating the benefit? 25% of the last drawn salary multiplied by number of years of service. That is your total projected cost. 24 lakh is a last drawn salary multiplied by 25%. How many years employee is expected to serve? 5 years. Calculate. How much are you getting? 30 lakh. That means company is expecting to pay a liability to this employee of how much? 30 lakh. Now or at the time of retirement? When is that employee expected to get retired? After 5 years. Still here all of us are on the same page. Calculation wise, understanding wise, all okay? Okay. Sir, you might be paying the benefit after 5 years. But does that mean this is an expense for 5th year or all the 5 years? 30 lakh you may be settling, company may be settling in the 5th year. But is it only 5th year expense or all the 5 years? All the 5 years. Yes, no, because only if the employee works for all the 5 years, he will get this benefit. So next is to find out benefit per annum. Benefit per annum. So this is what? Total benefit. How many years of service? 5 years. What is the benefit per annum? 30 lakh is a benefit for 5 years. Means for 1 year, what is the benefit? 6 lakh. Good. You can call it as benefit per annum or you can call it as projected cost per annum. Both are okay. Done, G. Everyone cool, G? Any problem? No. Now, people, now carefully listen to what I'm saying and help me decode this. Can a company book 6 lakh as an expense in first year P&L? You said benefit per annum is how much? 6 lakh. Right? For employee, it is a benefit. For company, it is a cost or an expense. So my question to you is, can company book 6 lakh as an expense in first year? Is it right? No. Why? Okay, fair enough. Any other explanation? Any other thoughts? Perfect. Sir, 6 lakh you cannot account because 6 lakh is not present value, it is future value. Because simply do 6 lakh into 5 you do, what are you getting? 6 lakh into 5 if you do, what are you getting? 30 lakhs. You are not settling the 6 lakh now, you are settling the 6 lakh after. That means what is this? This is present value or future value? Future value. Here time value, money, immaterial or material? Material. That means we have to find out what? Present value of this. We have to find present value of this. Okay, Naji, that's what I think you were planning to say, right? Yes, sir. That present value only we give a fancy name. That present value of this cost only we give a fancy name called current service cost. Current service cost. Current service cost means today's value of that service cost. Okay. Basically, we are trying to find what? Present value. Stay with me here. We are in which year now? First year. What is the benefit for first year? 6 lakh. This 6 lakh is present value or future value? Future value. We are carefully, we are on what date now? We are standing in what date now? End of first year. We are at the end of first year. When will you pay this benefit? End of fifth year. Count from year 1 ending to year 5 ending. Count how many years? From year 1 ending to year 5 ending, you count how many years? Year 2, year 3, year 4, year 5. Yes, sir. I mean, this benefit will be settled after 4 years. Agreed? This benefit will be settled after 4 years. Pakka? Come back to the question. How much, sir, to calculate the present value, we need discount factor? How much is the discount factor given in the question? 8%. Such nice problem. They have only given the discount factor. Check. 1. 1 means what? Year 0. Today's discount factor is always 1. At the end of first year, how do you calculate discount factor, people? 1 divided by 1.08. Do in a calculator. 1 divided, it's basically 1 divided by 1 plus I whole power n. I here is 8%. So do 1 divided by 1.08. If you press equals to button, what are you going to get? 0.926. That is first, with this 0.926 is what? This is first year ka discount factor. Again press equals to button. 0.857. Again press equals to button. 794. Again equals to button. 735. Yes, sir. Now for this calculation, which year ka discount factor I want? Fourth year ka. Because we are standing on what? Where are we standing? Year 1 ending. When is it going to be settled? Year 5 ending. From year 1 ending to year 5 ending, if you count, how many years? 4 years. Correct? That means which year ka discount factor we have to use? Fourth year ka. Fourth year ka, how much is it? 0.735. So take 6 lakh and multiply by 0.735. You will get the present value 4 lakh 40. Let everyone understand this. Everyone understand this. If you have got this next calculation, ditto, no change at all. Once more got it. Pakka, quickly tell. Yes. Okay, let's go for second year. What is the benefit every year? 6 lakh. What is the benefit every year? 6 lakh. Same drama. Now we are in which year ending? Now we are in second year ending. Settlement will happen when? Fifth year ending. Count from here to here. How many years? Year 3, year 4, year 5. How many years? 3. That means you will use discount factor for year 1, year 2 or year 3? Year 3. What is year 3 ka discount factor? 0.794. 6 lakh into 0.794 you do. You will get 4 lakh 76. 4. That is the expense you will book for which year? Second year. Okay. The third year now. What is the benefit for third year? 6 lakh. Now same drama. You are in which year? Third year ending. Settlement will happen on fifth year ending. From here to here you count. How many years? Third year ending. So year 4, year 5. How many years? 2 years. That means you will take which year ka discount factor? Second year ka. What is second year ka discount factor? 0.857. 6 lakh into 0.857. How much? 5 lakh 14,200. That is the expense you will book in which year? Third year. Now fourth year also, what is the expense? 6 lakh. Same drama. You are in which year ending? Year 4 ending. Settlement will happen on year 5 ending. How much is the gap? 1 year. So which year ka discount factor you will take? 1 year ka. What is 1 year ka discount factor? 0.926. 6 lakh into 0.926 will give you 555,600. Okay. Now we are in which year? Last year, which is year 5. What is the benefit for fifth year? 6 lakh. You are on which year? Fifth year ending. Settlement also will happen on fifth year ending. I mean, should you have to find the present value of this, or it is already on present value? Already on present. That's the reason we say for year 0, discount factor is always 1. So if you want, you can multiply by 1, or you can simply write what? 6 lakh. Don't write 0 pa. Brospati. Yeah. 6 lakh is already on present value terms. So we simply write what? 6 lakh. This is the cost that you will book in where? P&L. In the name of what? Current service cost. This is the most important working. If at all you do a mistake, probably it's going to be here. Rest everything, I think format will take care of. Okay, G. Same question you will find in CA final material also. Ditto. Same concept, everything same. Move on to the next. Tell me the entry pa. Or okay, tell me the first entry. What did I say? First you make provision, then you settle. Tell me. Employee benefit expense. Here anyway we have given a fancy name already. What is the name? Current service cost. So tell me from that perspective. So the entry you will pass is current service cost account debit to provision. Provision DCP na DBP na. You can call provision for DBP, or they will say provision for defined benefit obligation. Defined benefit obligation, or you can also call provision for DBP also, it is okay. But this is the name that usually many books call it. Provision for DBO. DBO means defined benefit obligation. This is a liability. Easy. And this should we have to calculate or already done? Already done. Here. First year how much cost? 441. Second year 476. That is what they have passed the end. We have passed the entry here. Okay na? Paka na? Take your calculator. Add all this for me. From here to here, add. Quickly add. From here to here, quickly add. Quickly. 25, 87, 200. That is what you are getting. So that means liability you are showing in your books. If you add all this, you are getting 25, 87, 200. But are you going to settle the liability at 25, 87 or 30 lakh? What am I hinting towards? We have done this. Lease may we covered this. 2587 is the present value. 30 lakh is the future value. The difference between those two is time value of money ka finance charges. For that you'll have to put up a table. You know the table. Tell me. Year, opening balance, finance charges. Here there will not be any payment. Payment will be done only at the end of the year. But instead of payment, substitute with current service cost and get what? Closing balance. Just the one substitute over here. Okay. Why is that? I'll tell you. So far, okay. Table way. Okay. Let's review this now. First, how many years we have to have the columns now? 5. Why 5? Company feels employee will retire after 5 years. So first year column we will write 1. First one is what? Opening balance is 0. Can someone tell me why? One explanation, you are booking the expense now or at year 1 ending. So this entry, this entry you will pass when? End of the year, at the end of the year. So provision for DBO balance is how much? At opening balance is 0. That is one explanation. Because you have passed the entry only at the year ending. Another explanation is, sir, when an employee joins the company will have obligation? No, company will get an obligation as and when the employee gives service. As and when the employee goes on giving the service, obligation will go on increasing. Immediately when employee joins the organization, company has no obligation. Hence, opening balance here will always be whichever suits you, you can take it. I think entry wala is easy. You're passing the entry when? Year, end of the year. So opening balance of DBO is done. Sir, you calculate interest on opening balance only, no? If this is 0, first year interest is also 0. Clear? Will there be any payment here? No. Instead of payment, which column? Current service cost. Why is this is? Sir, as and when the employee gives service, obligation or the liability of the company will be same or it will go on increasing? It will go on increasing. So hence, current service cost. What is the first year ka current service cost? 440. All the year ka current service cost from this table, punch it in here. And you have to minus this or add this. There in lease, if you remember, you used to write 2 plus 3 minus 4. Why? Because this was not current service cost, it was a payment. Here it's a payment or the current service cost. And why do we add this? Why do we add current service cost? As and when the employee gives a service, company ka obligation will go on increasing. Hence. Okay. Or another explanation. What is a journal entry for current service cost? What is the journal entry for current service cost? Current service cost to provision for DBO. Due to current service cost, you are crediting provision. When you credit a provision is a liability, no? When you credit it, its balance will increase. That's another point. Okay. First year ka closing will become second year ka opening. Now onwards, I think you know the calculation. Second year, how will you calculate interest? 441 ka 8%. Right. Like that. Done, Aji. Entry also tell me, for this finance charges, tell me the entry. In lease, may what entry you passed? Finance charges to lease liability. Here you tell. Finance charges to, what is the name of the liability here? Provision for DBU. So entry will be what? Finance charges or interest charges account debit to provision for DBU. Copy that. Clear? Confusion? No. Sir, here there are two expenses. Can you identify? Current service cost, interest charges. Both where it will go? Here. That is the transfer entry. Sir, settlement too. If at all you are settling at end of 5th year, the entry will be provision for DBO to bank. But employee can retire in 6th year also. Company is thinking employee will retire by 5th year. Employee may retire in 6th also, 7th also. Hence payment entry we don't pass here because we don't know when exactly employees will retire. When he retires, we will pass this entry. That we are not 100% sure, so we don't pass this entry. Just for your sample, I have brought it in. That is the whole accounting. Tell me, difficult or manageable? Once if you do, you can do it now. The only crux is the current service cost. Year ending to retirement date, you need to count. That if you do it properly, I think more or less taken care of. This is your PUCM method. Next. Can we get to the next one? Okay. Okay, next one, people. Actuarial assumptions. What is this? Sir, all these are chintu pintu liabilities or big ones? All these are big liabilities, but which are calculated using a lot of assumptions. These liabilities are calculated using a lot of assumptions. Like gratuity ka formula which we discussed. Throw it back. 15 by 26 into what? Last drawn salary multiplied by number of years of service. Last drawn salary pakka number or estimate? Now imagine. Last drawn salary is influenced by one variable or many variables. Employee super amazing worker. Company is doing horribly wrong. Will the employee get higher increment? That means last drawn salary is influenced by employee ka performance, company ka performance, country ka performance, world economy ka performance. Yes, no. If a world is in recession, employees will get higher hike. Means everything matters. So this is like easy calculations or lot of flowchart, lot of problems. Correct? No. So how will CA manage, sir? For as far as we are concerned, this is the easiest. As far as CA is concerned, this is the easiest. You know why? We will ask a report from somebody called actuary. We will ask a report from somebody called actuary. That actuary will give all this. We will see that report 20 lakh journal entry 20 lakh. Oh. We don't have to estimate even a single component of all this because we don't have expertise. Because a lot of variables are at play here. You need to use a lot of statistical tool. So practically company take the help of an actuary. Okay, using that they account. An auditor will say actuary certified. Super. I am also done. My audit evidence received. Very nice. Everybody happy. Okay, Nasa. This is how it works. But on the reality terms, there are a lot of assumptions. Like here, if you want to give a little more context to it, like let's say this. An employee is aged 25, let's say. He is working for a government company. You know, government mein how it works? No. It's our house only. Once we join, do you think anybody will quit a government job? Very rare, correct? No. Forcefully, he has to get retired. So let's say retirement age is 60. Employee age is what? 25. Retirement age is what? 60. So that means how many years this employee will give service to government? 35 years. So expected service is how much? Not 1 or 2, 35 years. That means what calculation you did now, you have to book it for 35 years. But hang on. Country ka mortality table says at the age of 58 Kailasa. At the age of 58 Kailasa. Means normal death rate for men in that particular region is given to be what? Men or women or whatever. It's given to be how? it's given to be what? 58. Okay. Now the question is, will you count from 25 to 60 or 25 to 58? Employee may want to serve till 60, but forcefully he's gone out only. At what age? 58. Don't you think this also influences your calculation? Yes, no? So this we call it as mortality. Now, all these are demographic assumptions. Because some countries, may Japan and all, France and all, people live up to 90, 95 and all. It's common for them. But in our city life, I think 50, 55, I think we should be ready. Yeah, we should be ready. We should be happy. Okay, whenever. Yes or no? It's not surprising these days, correct? So like that. So this also has an influence on your accounting is what I'm trying to say. So I think they liked that. Now they're discussing when they want to leave. Hey, discuss this now. Okay. So yeah. So there are a lot of assumptions which basically affects the value of liability. Danji. So that means we have to assume a lot of things. Our assumption will be pakka or it can change. Based on our assumption change, liability ka value also can change. That we call it as actuarial gain or actuarial loss. If assumption changes, our asset value, liability value also will undergo a change. And we will end up getting some gain or loss, which we give a fancy name called what, sir? Actuarial gain or loss. What AS 15 says is, if your assumption has changed, if there is any actuarial gain or loss, this is an important question for 1 marker or 2 marker. If there is any actuarial gain or loss, transfer it to P&L immediately. Transfer it to P&L immediately. Okay, this is one, which 1 or 2 marks may usually they ask. Has come, may come, I don't know. This is the funda. The main mudda of all this, the main overall point you need to remember from this is actuarial gain or loss to P&L immediately. As simple as that. Now people, there are 2 more type of question which usually gets asked around. That I think will get covered in this area. So let's run through this first, or maybe let's do this first and then I'll come to that. P&L presentation. P&L presentation means what and all will go to P&L. 2 things you already know. Make me happy. Current service cost, finance charges. Okay now. This is relating to what? These 2 are relating to provision for DBO. But do not forget there is also a plan asset. Do not forget there is an investment called plan asset. On plan asset, what are you going to get? That is an investment. On that, what you will get? Interest. Expected return on plan asset. That return also will go where? P&L. 3 are clear. Okay. Okay. Next is actuarial gain or loss. That we just now discussed. Actuarial gain or loss also will go to P&L. 4 are covered. 2 more. Past service cost, curtailment, gain or loss. Past service cost, curtailment, gain or loss. What is this past service cost? Past service cost means changes made to the plan. What did I say? Changes made to the defined benefit plan. Like, let's take this example. Sir, earlier, company had a plan to give pension, gratuity or whatever, some benefit they wanted to give. How that benefit was calculated was 5% of last drawn salary. Initially, what was the plan? Last drawn salary ka 5% will be paid as what? Benefit to the employee. That was the thing. After 2 years, company is doing really good. Company is doing amazing profits, amazing revenue. They're expanding. They're all over the place. Super, super, super. Hence, company decided we are here because of our employees. Instead of 5%, let's give benefit at the rate of 20%. Possible, no? So the benefit same or changed? Changed. That we refer to as what? Any changes to these plan we refer to as PSC. PSC as in past service cost. Okay, Naji. Meaning is okay. Now looking at the accounting impact of it. Now usually people, whenever some changes are made to the plan, okay, 2 terminologies will be thrown across. Vested past service cost, unvested past service cost. Vested and unvested. Vested means they are the past service cost relating to those employees who have already fulfilled the condition. Vested past service cost means either condition is already fulfilled or company has not put any condition at all. Unvested means condition is not yet fulfilled. Condition is still remaining. Like here, taking this example, what was the original benefit? 5. Revised benefit? 20. Company said we will give revised benefit to all the employees who have completed minimum 3 years. Who have completed minimum 3 years. Few employees have already completed. Few employees have already completed. Few are yet to complete. The employees who have already completed, for them, whatever benefit you are paying is called what? Vested. Some of them who are yet to complete, that we call it as what? Unvested past service cost. Okay, Naji? Condition fulfilled or condition not there means vested. Condition not there or condition already fulfilled means vested. Conditions not yet fulfilled means unvested. Okay, let's understand it in journal entry format. Let's take some numbers to it. Company wants to give an additional benefit of 500 rupees. Company wants to give an additional benefit of 500 rupees. Sir, what is the journal entry for current service cost? Don't look at the screen. Think and come back. Current service cost ka what was the entry? Current service cost to provision for DBO. On the same lines, tell me the entry for past service cost. Past service cost to provision for DBO. Because you are giving extra benefit means liability same or liability more? Liability more. So this is the entry. Clear? Now past service cost is an expense. Where should the expense go? P&L. But only vested past service cost goes to P&L. Unvested cost will remain as it is. We'll see what to do for that. Okay, now let's say in this 500, 100 is vested past service cost. 100 is how much? Vested past service cost is 100. So what you will do for that 100? Transfer it to P&L because condition already fulfilled. So what is the entry? P&L account debit to past service cost. How much? 100. This PSC ledger closed or it still has a balance? How much balance? 400. What sort of a balance? Debit balance. Correct. Here you have debited by 500. Here you have credited by 100. So net, how much balance remaining? 400. So that 400 is what? Vested or unvested? This is your unvested past service cost. Done, Naji? Now come back to that presentation. What have I written here? In bracket mein only amortized portion. Only amortized portion means only vested past service cost goes off to P&L. Unvested, what to do? I'll tell you in a bit. Put that on hold now. Did you understand this? So past service cost simply means what again? Changes made to the plan. Okay. So that is also basically your extra benefit. Usually you will increase the benefit or reduce the benefit? Increase. Because if you reduce the benefit, employees will be dangle mode. So usually that will not be done. Usually you will increase the benefit. So increased benefit straight away goes to P&L? No. Which goes to P&L? Only the vested portion goes to P&L. Unvested portion remains as it is. Next to last one which goes to P&L is curtailment gain or loss. Curtailment gain or loss. So to curtail something means? To curtail something means gone, go in the. Now if I say class curtailed, that means suddenly from here head went up like this. Alright? No, don't get excited. Some more time is there. Curtailment to gain or loss. Curtailment simply means you're putting an end. Now let's say people, let's take a small example. Basically one defined benefit plan was there. We cancelled it. Why? Sir, we had given a defined benefit plan to some of the division workers. One division was there. To such workers, we had given what plan? What benefit? Defined benefit plan. DBP plan. Benefit we had given. That division is performing horribly. Full loss and more loss. That employees are hardly working. We also tried. Hey, buckle up. They're like, they are in that full chill mode, Netflix and chill mode there. Okay, that division is making continuous loss. So we decided that enough is enough. Let's cancel the plan. Let's cancel the DBP plan. Okay, all right. Now people, whenever you cancel the plan, employees will be fully frustrated. So when you do a cancellation of a plan, there are two modes of doing cancellation. One with the settlement, another without settlement. With the settlement means you will give some money and say, not bye. You say, don't expect anything more. That's all. This much only I can afford. This much only you take and okay, nah. That is your Curtailment with what? With settlement. Curtailment without settlement means I cancelled the plan and I said I am not giving you even a single rupee. Enna pandriyo panniko po. I will not give you money. That is what curtailment without settlement. Okay. It could be with or without, the question will specify. If it is with, let's see what happens. Sir, on the day you cancelled the plan, you already have accounted liability. What is the name of the liability? Provision for DBO. Provision for DBO balance is 70 lakh. On the day you cancelled, provision for DBO balance is 70 lakh. You told the employee, take 60 lakh and settle. Take 60 lakh and settle. How much liability value? 70. How much settled? How much not settled? This is your curtailment gain, which goes where? Yeah. Okay, Naji. Suppose you paid 80 lakhs. Suppose you paid 80 lakhs. That means what it will be? It will be a curtailment loss. Where it will go? Paid. Suppose you paid nothing. Then full 70 lakh is your curtailment gain. Where it will go? Paid. Like that. So this curtailment gain or loss also goes off to paid. This is another kind of question which may come. Then they may give you categories and say where it will go, what it will go, and etc. etc. P&L over. Now next one. In balance sheet. Sir, 3 accounts has balance. Make me happy. 3 account has a balance. Which 3 account? Relating to DBP, 3 accounts have balance. Provision for DBO has what balance? Tell me with the balance. Provision for DBO is a liability. Has credit balance. Next. Which one? Unamortized past service cost still has a balance. What balance? Come back to this example. What balance? Debit balance. Another one. Make me happy. Another one. Correct. Tell little loudly, macha. Plan assets. Investment you are making? No. Plan asset is another ledger which has a balance. Investment has what balance? Debit balance. So there are 3 ledgers. Plan asset, debit. Unamortized past service cost, debit. Provision for DBO, credit. What AS 15 says is, don't show all the 3. Don't show. Net it off and show 1. Net it off and show 1. If liability is more, after netting off, if liability is more, then show it on the liability side. After netting off, if asset is more, show it on the asset side. Usually 99.99% of the case, liability only will be more. Why? Sir, if liability is 100, people will invest 120. No. If liability is 100, companies may invest 50 rupees, 60 rupees max. Because company, when they take money, they want to invest in plan assets or run the business. So usually debit balance scenario is very rare. So that is what I've written here. So in balance sheet, what are you going to do? First, take provision for DBO balance. Let's say I've assumed it to be 1000. You will have unamortized past service cost. I think here, how much was unamortized past service cost? 400. Net it off. Then fair value of plan assets at year ending, you net it off. That I've assumed it to be 500. These two debit. This one credit. When you net off, which is more? This is 1000. This is 900. Which is more? Liability is only more by how much? 100. So where will this come? You will show net defined benefit obligation in balance sheet under which side? Liability side. If asset is more, then we'll say net defined benefit asset. Net defined benefit asset. Very rare case. That's your presentation, sir. Can I carry on, sir? Oh. You are seeing stars, so I am seeing something else. So, okay. This one you know already. Actuarial gain loss, where it will go, sir? P&L immediately. For this and all, I will teach you. Will hit me only, I think, again now. So, how many more I have to cover? Okay, I have 2 more people. Let's quickly done, do off. Questions wise. Which one we will do first? This or that? Okay, this one we will take it. Okay, Rockstar Limited. Rocky boy. Study mat question. They want to discontinue a segment. Which concept? Discontinue a segment. Which concept? Just now we discussed. Tell not, curtailment. Oh, yes, Okay. Under the agreement with the employee union, the employees of discontinued segment will earn No further benefit. Obviously, if you have discontinued, you will give more benefit or you will stop it. This is curtailment with water, without settlement. Full goinda. This is story. Neither you have time, I have time. Let's not worry about that. Let's go into main matter. Rockstar estimates the share of unamortized service cost that relates to part of obligation is 8. I suppose something that given per leaf. I think I don't need that. Calculate the main, look at the main requirement. Calculate the gain from curtailment and also liability after curtailment. Two things. Curtailment gain or loss you need to compute, and after curtailment what is the liability. Sir, after curtailment liability is 0, no sir. Hey, one division ka plan you are cancelling. There are other divisions also, no? Whole company ka plan you are cancelling or only one division? One division ka. Other division still has what? Provision for DBO. That balance is what they are asking. Okay. After what? Curtailment. Immediately before curtailment, the gross obligation, that is provision for DBO, how much balance? 6,000. Write that. Before curtailment, provision for DBO balance, how much? 6,000. Then the fair value of plan asset is how much? 5,100. So plan asset ka balance is 5,100. All these are before. Okay, Ji. In balance sheet, three things you net off and show. Tell me what again? Once again, what is that? Provision for DBO, plan asset, unamortized past service cost. Unamortized past service cost is given. Yes. How much is that? 180. All these are before curtailment. Unamortized past service cost is 180. All these three are visible in the question. These two will have debit balance. This one will have credit balance. Net off. What are you getting? You're getting liability only more, no? By how much? 720. Yes, Chi. So we call it as net defined benefit obligation. Before curtailment, this was your liability value. Hanji. Now what happened, Ji? Check this. Curtailment reduces the obligation by 600, which is 10% of gross obligation. You did a curtailment. When you do a curtailment, liability will be same or it will reduce. You don't have to pay a liability to that division ka employees anymore. No? So liability will reduce. Should we have to find that or given? It will reduce by how much? 600. How much was the liability before? 6,000. How much it got reduced by? 600. From 6,000, it reduced by 600 and became how much? 5,004. Correct now? This is okay now. Sir, past service cost means what? Past service cost means what? Additional benefit. Additional benefit. Now, one division is closed. One division is closed. Will you give extra benefit to them or that will also get reduced? That will also get reduced. Yes, no? See, as long as you are giving the benefit to that division, you will also give extra benefit also. Now, what are you giving benefit to that division or are you curtailing it? Curtailing it. That means, do you think unamortized past service cost will be 180 or it will also reduce? It will also reduce. How? Prorated. Very simple. Here, how much was DBO before curtailment? 6,000. How much was past service cost before curtailment? 180. If this is 6,000 means past service cost is how much? 180. If this is 6,000 means past service cost is 180. After curtailment, DBO is 6,000 or how much it became? 5,400. After curtailment, liability ka value is only 5,400. So that means how much is past service cost ka value? Proportionate. If this is 6,000 means past service cost is 180. If liability has become 5,400 means how much is past service cost? Proportionate intel, how much is that? 162. Yes, so that's what they said over here. It reduces by 18. They've given. Yes, no. If you do over here 180 minus 18, you do how much is it? 162. Sometimes they give, sometimes they don't give. Hence, I always prefer to do it in a proportionate way. Okay, now this is a curtailment with the settlement, without settlement. Without settlement. Sir, if you are settling any money, it will come out of the bank balance or you will sell plan assets. Why did you buy plan assets? Why did you first of all buy this investment? To settle the obligation. To settle obligation only you have purchased an investment. So whenever you have to settle an obligation, what the company will do? Sell the investment. Sell the investment. But this is what? Curtailment without settlement. Curtailment without settlement. So should we sell plan asset or not required? It means plan asset ka value will change or same. Suppose it was a curtailment with the settlement. Curtailment with settlement. Suppose 100 rupees is settlement. What you would have done? 100 rupees is settlement. Then what you would have done? You would have sold plan asset worth 100 and this would have become how much? Understood? Pakka na. Since this is curtailment without settlement, you don't have to sell any of the plan asset. So it will remain exactly the same. Now when you net off, what are you getting? Now when you net off these three, what are you getting? 138. What is this 138? What is this 138? Liability after curtailment. Liability after curtailment. Before curtailment, how much it was? 720. After 138. So liability value increasing or reducing? Sir, if a liability reduces, it is a loss or gain? Gain. How much it reduced by? That's what they asked. That 582 is what? Curtailment gain, where it will go? P&L. And after curtailment, what is the revised liability? 138. That's what you have to write. Okay, na macha? Done. Full mauna they have become. Okay. Find. I told no 1.5 hours before I started only. More or less same. See, I'm on target now. One more question, one more concept. This standard, according to me, is over. Remaining is your practice. But practice, that's all. All these are simple. See, regular class mein for each concept we have done at least two questions. So it will be easy to hang off it. But now if you have not done any question at all, you have to use this and practice some questions. Then you will get the hang of it. And moreover, I have told all this will any which way continue also. So good to know them. Now, there is one more question which is popular, which can come as this. I have written something. Wait, actual return on plan assets. That is given by one formula. You can mug up the formula or you can remember the logic of it, your call. If you want to mug up it as a formula, if you want to get actual return on plan assets, what you have to do is take the fair value of plan assets at year ending, add benefits paid, reduce contribution, reduce fair value at year beginning. By do this plus minus, you will get actual return on plan assets. Okay. If you don't want formula, I will tell you one logic method, one formula, one question. Can we take that up? Only 3 of them are saying yes. Others are wanting do whatever the hell you want. I have already in Buddha's zone already. Yeah. Okay. Question number 10. Excuse me. On 1st April, the fair value of plan asset is 1 lakh. So 1st April balance is what? Opening balance. How much is that? 1 lakh. This is in respect of pension plan. Pension is a DCP or DBP? DBP, because you have an obligation to pay full pension. So it's a defined benefit plan. On 30th September, plan paid out benefit of 19,000. Sir, if any employee retires, what we have to do? We have to give him that benefit, right? How will you give the benefit? By selling the asset. When you sell an asset, we say benefit has been paid. You will sell the assets worth how much? 19,000, and this 19,000 will be given to the retired employee. Okay, Ji? This is benefits paid. And received inward contribution how much? 49,000. Sir, plan asset you will invest only once or frequently? Maybe monthly, maybe quarterly, maybe yearly. That here in AS15 terminology, we call it as contribution. Contribution simply means additional investment purchased. Additional investment purchased. How much is that? 49. On 31st March 20x2. 31st March means OB or CB? CB as in closing balance. Of what? Plan asset. How much is that? 1,50,000. Sir, simply open plan asset ka ledger. If you don't want formula, simply open plan assets ka ledger. Plan asset is what? Asset. It's an investment which is an asset. Asset ka opening balance, where it will come. What is the opening balance of asset? 1 lakh. So open this ledger and write opening balance 1 lakh. Okay. Now Did you pay any benefits? How much? 19,000. Benefits will be paid to whom? Employees. How will company get money to pay this benefit? They have to sell the plan asset. How much money you need to pay the benefit? 19,000. So how much investment value you will sell? 19,000. What's the journal entry for investment sold? What is a journal entry? Investment worth 19,000 sold. Bank account debit to investment. Here are we calling investment or are we calling plan asset? Revise the entry. Bank account debit to plan asset. When you post, credit side by 19, by bank 19. Okay. Next, how much inward contribution you received? 49. What does inward contribution mean? Additional investment purchased. What's the entry? Instead of saying investment to bank, you will say plan asset to bank. How much? 49. Where you will post? Debit side to bank 49. Agreed on. Do you know plan asset ka closing balance? How much? Where will asset ka closing balance come? As what? By balance carried. Now total, these two ka total is how much? 169. If you add these two, is it coming to 169 or balancing figure? How much balancing figure? That is nothing but actual return arrived as balancing. Okay, this is ledger. Easy. But ICA presents in format, formula, equation. So I suggest don't use ledger, use formula. What is that formula? Now you want to get this as a balancing figure. How will you get? These two which are coming, you add. These two you minus. That's all. Take a calculator and try if you want. These two you add, these two you minus. These two you add, these two you minus. Are you not getting 20? Express that in equation for me. What is this? What is 150? Plan asset ka closing balance. To that what you will add? Don't say bank. Do say what is this? Add benefits. Oh, what is this? Contribution. What do you have to do? Plus or minus? Minus contribution. Minus what? Opening balance. That's what I've written in chart here. Take closing balance, add benefit, deduct contribution, deduct opening balance. You will get actual return on plans. I say a suggested answer will always be in this format. My suggestion is do like this. In case you don't get it at all, if you forget the formula, put up a ledger. Your call. Okay, this is what we calculated here first of all. Actual return on plan assets. Actual return on plan assets. Sir, when we are making an investment, we will have certain expectation. Our expectation and actual should be same, or it may not. May not, because assumptions can change. So two things they will ask here. One, actual return on plan assets, which is this. Actual return on plan assets, which is this. One more thing they will also ask is expected return. If you just check, I'll show you. You need to find the expected return as well as actual return. Expected return as well as actual return. Actual return we have already done. Now we just simply need to know how to calculate expected return. Fine. Now people check. They have given some based on some market studies. So they are saying how much return you can expect. Some breakup they have given. I don't need all that. Final number I need. How much is that? 10.25%. So we are expecting a return on our plan assets to the extent of how much? 10.25%. Take your calculator, all of you. What was my investment account ka opening balance? 1 lakh. Yes, sir. I have an investment whose value is how much? 1 lakh. How much return am I expecting? 10.25% for the whole year. So on my 1 lakh, how much return am I expecting? 1 lakh into 10.25%, which is how much? 10,250. Agreed? Agreed? Correct? Work. Now, sir, how much benefit you paid? 90. But how much additional investment did you purchase? 49. If you just check, both ka date different or same. On one hand, may you are saying I invested 49. On another hand, may you are saying I withdraw 19. So how much net may got invested? 49 coming in, 19 going out. Net may how much did you invest? 30,000. Yes, sir. 30,000 money got invested. So if you have invested some money, you will expect a return. How much investment? 30,000. How 30,000? 49 minus 19. How much is that? 30,000. Fine. Now 30,000, on that 30,000 also you will get a return. But don't calculate 10.25% because this 10.25% is for the whole year. It's for the whole year. This 49 minus 19, when you did, you got 30, no? This you invested for the whole year or 6 months? 6 months. Why? Because you are doing all this transaction when? 30th September. Leave 30th September. That means the period is 1st October 20x1 to 31st March 20x2. How many months is that? 6 months. So if you invest this 30,000 for only 6 months, will you get full year return or 6 months return? Calculate that. How are you calculating? How are you calculating? 30,000 into 10.25% into 6 by 12. How much are you getting? 1537. But study material told 1500. How much you told? 1537. They are saying 1500. Who's right? You are them. Someone is actually punching once again. I think calculator working properly. Or calculator also Buddha zone. Not how much. Correct only. 1537. You are also right. ICA is also right. Just that what you are doing is simple interest. What ICA is doing is compound interest. What you are doing is simple interest. What ICA is doing is compound. So yeah, I don't know why pa. And final stage mein, in almost all the solution of ICI we take simple interest only. What you told only is the right answer. But inter mein, I don't know what creativity ICI material used. They suddenly started using compound. Nowhere it is mentioned compound. But still material mein they have used compound. So better for exam we will also use compound. And sir, compounding can happen quarterly, whatever, sir, always half yearly. Why, sir? ICA is Zindabad. What do I know? Their assumption I am telling you. That is what they are doing. You also follow same for exam. Okay, now they are assuming that compounding is happening when? Half yearly. That means you can't take this rate because this is a rate for what? Whole year. How to calculate that now? Now, so much mathematics you also don't want. You can actually approve it to you in regular class like this and all. Okay, but no, but looking at your face, I'll tell you one simple way, easy way, pa. See, she knows that. That also I think I told in class. 10.25 is there, no. Half yearly means 6 months once, right? In a year, how many half years are there? 2. So divide by 2. 10.25 divided by 2. How much is that? 5 point. Round it off to the lower number. Round it off to the lower number. How much? 5. Calculate. 30,000 ka 5% you do. 30,000 ka 5%. 1,500. That's all. Easy way. No need for any creativity. You can use creativity like this. You can prove it. But I think we don't need all that. It works almost in every way. Okay. Just divide by 2 and take to the lower number. Okay. But other way, I mean, you want me to really explain all this now? Fine. No. Okay. Fine. Very simple. Divide by 2 and round it off to the lower number. It will always work. So don't worry about that. So that means how much return are you expecting? 10,250 on 1 lakh. 1,500 on 30,000. So totally how much? 11,750 you are expecting. How much did you achieve? 20,000. So the difference is your actuarial gain. Actuarial gain. You expected 11,750 but you achieved 20,000. Yes, no. Assumptions can change, no, sir. So due to assumption change, your return, your expected return and actual return may not match. So because all this value is given by actuary. This closing balance and all is given by actuary. They will take the futuristic assumption and derive this. Okay, so every year assumption will keep getting changed. Okay, so that means this number will keep changing. So your return and expected return will not match. That difference only we call it as actuarial gain or actuarial loss. Here you are getting more. We expected 11,750. We achieved how much? 20. If you're getting more, it's a loss or gain. Gain. That's it. That is another kind of problem which can come. Got it? Okay. This done, this done, this done. Okay. Problems, all the questions I had in mind is done, sir. Now, if you remember, I told there are 4 types of benefits. What are those? Short-term employee benefits, Post-employment benefits or termination benefits. We have covered only two. There are two more. Another two more we are looking at. Third one is termination benefit. Termination benefit means you fire the employee. Whenever you fire the employee, you will give some money. The termination could be voluntarily or forceful. Employee resigned on their own, or it could be a force. Doesn't matter. Both will come here. Okay, sir. All right, sir. When will you recognize termination benefit, sir? You do the same accounting. What accounting? Expense liability accounting. But in order to start the accounting, we say you should make a detailed formal plan, and that plan should be approved. Because firing employee and all, sir, it's a major decision. It will affect the company in a serious way. So one, if you want to account this expense, you should take some, like director should have passed some resolution for it. That's what we mean by detailed formal plan, which is duly approved. Approved by whom? The management or board of directors. That, because once the resolution is passed, is that news just like that, or it's a pakka news now? Pakka employees will get fired, yes or no? So that is the basis. So one, that detailed formal plan. What is that formal plan? Oh? Sir, if there are 1,000 employees, we will fire all 1,000 or only few? Only a few. Which location ka employee we are firing? How much compensation they will get? How long, how many more months they will work? All that details you have to mention in the plan. It has to be planned as well as it has to be approved. And how much is the compensation you are paying also should be clearly identified. The day these two are satisfied, that day you will do what sort of accounting? Expense liability accounting. That day you will book the expense. Till then you will not book. Okay. Now how do we account this as? Very simple. If that termination benefits is expected to be settled within 12 months from the balance sheet date, it will be accounted like what? Step. You know how to do first step? Same expense liability accounting only. Meaning discounting and all required or not required? Not required. If settlement is expected to happen beyond 1 year, you go for what? Post-employment benefits. Remember PUCM method we did? You'll have to account it like this. So anything new or ditto? Ditto, same. So based on the settlement period, either it will be accounted as step or you will go for PUCM method wala accounting. This is for what? Termination benefit. Third one also over. Fourth one, other long-term employee benefits. This is a residual category. If a expense cannot be put into other three categories, it will come into which category? Other long-term employee benefits. Basically residual, balancing figure category. Okay. Examples could be some jubilee bonus we say, like many companies will have this. Work in my company for 3 years, take 3 lakh. Work in my company for 3 years, take 3 lakh. Work in my company for 10 years, take 10 lakh. Like this they will have. Now, is it short-term employee benefits? Huh? Is it short-term employee benefits? No. Is the employee retiring? No. So, is it post-employment benefits? No. Are you firing employee? So, is it termination benefit? No. So, it comes under which category? Other long-term employee benefits. Congratulations. Same. Sabbatical. Sabbatic means long break. You told the company, I will not come for work for the next 3 years. Next 3 years. Company is saying, no problem, go and come. Enjoy your world tour and come back. Okay, that is sabbatical leave. Okay, which company? Good question. Even I am finding. I didn't find it. When I find, no, first I will join, then I will tell you. Okay, yeah. And now, accounting is same. Accounting same. PU, CM. PU. Remember PUCM accounting we just now did? Same accounting you do it for that also. That means nothing new. Ditto, ditto, ditto. Congratulations. Take care. Bye bye. Hey.